Like the idea of investing in real estate? What if you could own a slice of thousands of commercial properties without doing any hard work? Want to also collect a big, safe, growing monthly dividend? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business owns thousands of real estate properties leased out to tenants across hundreds of industries. You know what they say about real estate? They're not making any more land. You know what else they say about real estate? Location, location, location. Well, this company takes advantage of both of those adages. It's a real estate wizard that has built an enviable portfolio of thousands of properties. And these properties are in some of the best locations across various localities. This allows them to collect monthly rent checks from their tenants, which they pass along to their shareholders in the form of a large monthly dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Realty Income Corp, which appear to be trading at a significant discount today. Realty Income Corp, stock ticker O, is a real estate investment trust that leases freestanding, single-tenant, triple-net leased retail properties. Founded in 1969, it's now a $22 billion by market cap real estate giant that employs more than 200 people. Their portfolio of over 6,500 properties spreads out across 49 US states, Puerto Rico, and the United Kingdom. They have approximately 600 clients operating across more than 50 industries. While the S&P 500 has been making new all-time highs, this stock has been languishing as if it's permanently and deeply scarred by the pandemic. I think some investors see that it's a retail real estate company and immediately run for the hills. But that's where there's an opportunity for more enterprising investors who know how to look beyond a stock name and actually delve into real business numbers. Realty Income ended fiscal year 2019 with a 98.6% portfolio occupancy. The company ended fiscal year 2020 with 97.9% portfolio occupancy. Sure, 98.6% is better than 97.9%, but let's be clear, this business has most certainly not fallen off a cliff in the manner that its stock performance would have you believe. While the stock is well below its pre-pandemic price of over $80 a share, it's easy to see why the business has actually held up pretty well. They own quality properties in great locations, and they sign well-capitalized tenants to long-term triple net lease contracts. These tenants are often some of the biggest and best businesses in the world, and many of these businesses have been barely affected by the pandemic. Some of Realty Income's top tenants include Home Depot Inc. and FedEx Corporation. A pandemic doesn't mean these tenants suddenly go bust, nor do leases suddenly become null and void. Owning Realty Income stock has always given you the chance to effectively act as a landlord, quote unquote, and collect, quote unquote, rent checks without doing any of the associated hard work. But the pandemic has proven out the value of their large, diversified portfolio of commercial properties. Compare that to many mom and pop rental property landlords who have been hurt by non-payments. Realty Income's dividend was reliably paid and increased straight through the crisis. By the way, Realty Income sends shareholders monthly dividends, just as if you owned these properties directly and were collecting rent every month. The company prides itself on this fact so much that it has branded itself the monthly dividend company. Realty Income's diversified portfolio and strong tenant mix serves them and their shareholders well, and it should allow them to continue paying out their large, growing monthly dividend. That monthly dividend has now grown for 28 consecutive years, which dates back to their initial IPO. The 10-year dividend growth rate is 4.9%, And that's an impressive level of growth when paired with the stock's current yield of 4.6%. This yield, by the way, is 40 basis points higher than its own 5-year average. The payout ratio is 85%. Their payout ratio might look high at first glance, but REITs typically operate with high payout ratios. A REIT is legally obligated to return at least 90% of taxable income to shareholders in the form of dividends. This is a large monthly dividend growing at a mid-single-digit rate, and it's been one of the surest dividends right through the crisis. A lot to like about that. Looking at business growth, Realty Income grew its revenue from $421 billion in fiscal year 2011 to $1.652 billion in fiscal year 2020. That's a compound annual growth rate of 16.4%. Stunning, truly. But we have to remember that REITs like this one typically fund growth by issuing equity and debt. That's because they're returning most of their cash flow to shareholders. As such, it's particularly important to look at a REIT's profit growth on a per-share basis rather than in absolute terms. And when looking at per-share growth for a REIT, you want to look at funds from operations instead of normal earnings. This is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back to earnings. The company increased its funds from operations per share from $1.98 to $3.31 over this 10-year period, which is a compound annual growth rate of 5.88%. That's a more accurate look at the true growth profile of Realty Income, which is still very solid. Looking forward, CFRA currently has no near-term funds from operations per share growth forecast for Realty Income. The last time I looked at CFRA's growth forecast for Realty Income, which was back in May of 2020, they were forecasting 5% funds from operations per share growth for the REIT over the next 3 years. I don't see any deterioration in Realty Income's business model since May of 2020. If anything, things look much better and more certain in March 2021 than they did in May 2020. We have a bright light at the end of this tunnel, and that light is getting closer. In the end, I view a 5% 3-year funds from operations per share growth forecast as reasonable, and that's what I'll continue to work off of. This level of growth would be a drop from what the company has produced over the last decade, but the pandemic won't leave them completely unscathed. Modeling in a slight drop in growth over the near term strikes me as prudent. I will highlight a portion of CFRA's note on Realty Income that I think is useful, and I quote, "We see robust demand continuing for freestanding retail space driven by a favorable supply-demand environment. While the COVID-19 pandemic has certainly affected Realty Income, we forecast the company will fare relatively better than peers, given its top tenants are concentrated in industries deemed essential, such as convenience, drug, and grocery stores." Unquote. A 5% near-term funds from operations per share growth rate would imply a similar dividend growth rate, which would basically translate to a continuation of the long-term status quo. And I like that. Moving over to the balance sheet, Realty Income sports a strong financial position. They have $9.7 billion in liabilities against $20.7 billion in assets. Their credit ratings are well into investment-grade territory. A3 from Moody's, A- from S&P Global. Furthermore, many of the company's top tenants have excellent financial positions of their own. Realty Income is perfect for an investor who wants exposure to real estate but doesn't want to do the hard work. You get that monthly quote-unquote rent check without having to worry about scouting properties, securing loans, finding tenants, managing properties, and arranging for maintenance and repairs. Buying a stock is a lot easier than buying properties, especially on the commercial side. Then you can just sit back and collect a monthly dividend check that's growing. And while competitive advantages are difficult to secure in real estate, I believe the company's deep expertise, long-term contracts, and massive scale do give it competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The long-term effects from the pandemic are still unknown, although the company's financials have held up remarkably well. Real estate is cyclical. Demand for its properties and the health of its tenant can oscillate. As a REIT, its capital structure relies on external funding for growth. This exposes the company to volatile capital markets and interest rates. Higher interest rates are a risk, debt becomes more expensive, and the stock can look less appealing in comparison. Any kind of recession would hurt the REIT twice over. There's the reduction in demand for real estate, and equity issuances after a drop in the stock price would come at a higher cost. Their diversification is working to their benefit, but large-scale changes in physical retail could hamper long-term growth. With these risks out in the open, I still believe this business can make for an excellent long-term investment. That belief is partly predicated on the fact that it's been an excellent long-term investment. The stock has provided a compound annual rate of return of 15.3% between its 1994 IPO and the end of 2020. But with the stock down almost 20% over the last year, I think it's attractively valued here. Shares trade hands for a price to funds from operations ratio of 18.1. This would be comparable to a price to earnings ratio on a normal stock. Compared to the broader market, this is a relatively low multiple. But I think it's even better than it looks. That's because funds from operations is being slightly depressed by the pandemic. There's also the cash flow multiple to look at. The price to cash flow ratio of 19.0 is lower than the stock's own 3-year average price to cash flow ratio of 19.5. And the yield, as noted earlier, is measurably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate and a long-term dividend growth rate of 4.5%. This dividend growth rate is lower than both the company's demonstrated long-term dividend growth rate and the long-term funds from operations per share growth. It's also lower than the 5% near-term funds from operation per share growth forecast I referenced earlier. I view this as a pretty cautious expectation, and I fully believe that Realty Income can at least meet this expectation. It wouldn't surprise me at all to see them exceed it. The dividend discount model analysis gives me a fair value of $65.25. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates O as a 3-star stock with a fair value estimate of $66. CFRA rates O as a 4-star buy with a 12-month target price of $66. We have an extremely tight consensus here. Averaging the 3 numbers out gives us a final valuation of $65.75, which would indicate the stock is possibly 7% undervalued. Here's the bottom line, guys. Realty Income Corp is a high-quality real estate investment trust that offers shareholders the opportunity to garner instant scale in commercial real estate. This stock pays out a monthly rent check dividend, while the shareholder landlords do none of the hard work. With a market-smashing 4.6% yield, more than 25 consecutive years of dividend increases, inflation-beating dividend growth, a reliable monthly dividend, and the potential that shares are 7% undervalued, this stock should absolutely be on your radar if you're looking for a safe, large, monthly dividend. And now for a special news announcement. Aerojet Rocketdyne Holdings Inc. says its shareholders voted overwhelmingly in approval of the proposed acquisition by Lockheed Martin Corporation. This is fantastic. I previously noted this acquisition as being a great bolt-on move for Lockheed Martin and their space ambitions. Lockheed Martin remains one of my top 5 stocks for 2021. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.